Welcome everybody to our channel. Today we should learn various concepts or the different key points of share capital. I am sure if you watch this video till the end, all your doubts on share capital must be cleared. So let's start our today's topic. The share capital means the capital which is raised by a company by issuing shares is called share capital. So now come to the first point, that is types of shares. Generally, a company issues two types of shares for raising its capital. Such shares are, first one is equity share and second one is our preference share. So the capital which is raised by company by issuing equity share is called our equity share capital, whereas the capital which is raised by issuing preference share is called our preference share capital. So as the name suggests, here preference share means the share which have two preferential right, that is guaranteed payment of dividend and second preference is repayment of the capital, whereas equity share means the share which is not a preference share is called our equity share. Generally, the equity share carries the ownership right, or the equity share provides ownership right to its holders. So the share capital which is raised by issuing equity share is called our equity share capital, and the capital which is raised by issuing preference share is called our preference share capital. Generally, the share price is collected by a company in a single installment, or it may be collected in a number of installments. So the share price generally collected number of installments, that is on application, on allotment, on different calls, or on first call, on second call, and the last call is called our final call. Generally, the share value is collected in number of installments, that is on application some part of the share value is collected, on allotment, on first call, on second call, and on final call the total amount is, or the total share value is collected. So our first point is the shares which are issued by a company for raising share capital, that is two types, with equity share and preference share. The capital which is raised by issuing equity share is called equity share capital, and the capital which is raised by issuing preference share is called our preference share capital. Now come to the second important point, that is purpose of issuing shares. Generally, a company issues shares for two purposes, that is first one is for cash and our second purpose is for consideration other than cash. Generally, when shares are issued for cash, the company arranges or collects the share value in number of installments, or it may collect the share value in single installment. But in case of when the shares are issued for consideration other than cash, that means for the purchase of assets. That means the company purchases assets and issues the shares to the vendor or the supplier of the asset instead of paying the money for the assets purchased. So in each stage a company passes two types of journal entries. So our next point is journal entries passed under share capital. Generally two types journal entries are passed. First one is due entry and our second one is receive entry. In each stage company passes two entries, that is due entry and receive entry. But in case of application, company first passes receive entry and then due entry, whereas in case of allotment or other calls we should pass due entry first and then our receive entry. So our due entry is concerned call account debit to share capital account. But when the shares are issued at premium, then we should credit security premium account, and when the shares are issued at discount, then we should debit discount on issue account. So the discount on issue and our securities premium generally treated at the time of due entry. So when it is given a particular call, we should treat the discount or premium in that particular call. When it is, or when nothing is given, generally premium and discount is treated at the time of our allotment entry. So here concerned call means the respective call. That means when we should pass the application entry, that means share application account debit to share capital account. Similarly, when we should pass our allotment entry, here share allotment account debit to share capital account. When we should pass the first call entry, so here share first call account debit to our share capital account. When we should pass the second call entry, share second call account debit to share capital account. And when we should pass the final entry, then the entry should be share final call account debit to share capital. That means the concerned call should be replaced by the respective calls. That means in case of application, allotment, first call, final call and second call, we should change the concerned call as the application, allotment, first call, final call. Similarly, come to our receive entry. So receive entry is bank account to debit to share concerned call account. Similarly, the concerned call should be changed or replaced by application, allotment, first call, second call and our final call. When there is arrear or advance, then in case of arrear, calls in arrear account should be debited, and when there is calls in advance, then it should be credit calls in advance account. So the calls in arrear and calls in advance is treated at the time of our receive entry. So these are the three important points of our share capital. Now come to the fourth important point of our share capital. Our fourth point is subscription. That means the applications received from public to purchase shares. Generally, the subscriptions are broadly divided into three types. That is our under subscription, and second one is full subscription, and our third one is over subscription. So as the subscription means applications received from public to purchase the shares issued by the company is called our subscription. There are three types of situations arises. That is, sometimes people may purchase the shares less than the shares issued, or the public may purchase 100% shares issued by the company, or there may be people are ready to purchase more than the shares issued by the company. So here under subscription means the number of applications received, number of applications received is less than the issued. That means the situation where number of applications received from the public is less than the issued or the number of shares issued by the company is called our under subscription. In this situation, all the journal entries are passed on the shares on the number of shares actually subscribed by public. Whereas full subscription means the situation where number of applications received is equal with the number of shares issued by the company. That means number of applications received is equal with number of shares issued by the company is called our full subscription. So there is no need of any rejection or no need of any adjustment. Then come to the third situation, that is our oversubscription. That means the situation where number of applications received is more than the number of shares issued by the company. So in this situation, there is two options in the hands of the company. That means the number of shares oversubscribed, such oversubscribed shares may be rejected by the company or may be adjusted. When the company decided to reject the oversubscribed shares, he may refund or he should refund the money to the public, or in case of company decided to adjust, it should transfer the excess money towards allotment or future calls. So when the company decided to adjust the money in future calls or in case of oversubscription, generally our application entry is passed on the number of applications received, whereas all other calls should be, or whereas the entries of our other calls should be passed on the number of shares allotted by the company. So this is all about our subscriptions. So let's repeat again. Generally, subscription is of three types. First one is under subscription, where number of applications received is less than number of shares issued by the company, is called under subscription. Or the situation where number of applications received is equal with number of shares issued is called full subscription. And the situation where number of applications received is more than the number of shares issued by the company is called our oversubscription. So in case of oversubscription, there is a option of rejection or the option of adjustment arises. So when the company decided to reject the oversubscribed shares, he should refund the money to the prospective shareholders, or when it decided to adjust the money, it should transfer the excess money towards allotment and the future calls. So in this situation, the application entries should be passed on the number of applications received, and the allotment and other calls money should be, or other calls entries should be passed with our shares, so with the number of shares allotted by the company. So now come to the next point, that is allotment. Then our next important point is allotment. So the allotment means acceptance of applications sent by prospective shareholders. That means the acceptance of applications or the applications of the shareholders should be accepted, and the shares should be allotted to the shareholders or to the publics. So such allotment generally divided into three types, that is full allotment, no allotment, or our third one is pro rata allotment. So now come to the full allotment. Full allotment means 100% acceptance of applications. That means such category of prospective shareholders should be allotted 100% applications. That means the number of applications received from such type of prospective shareholders should be allotted equal number of shares. So here number of applications received equals with number of shares allotted. Whereas in case of no allotment, total applications should be rejected. That means rejection of applications. That means the applications received from prospective shareholders should be completely rejected. That means no allotment should be made such type of prospective shareholders. So in this situation, the company should refund the money received from prospective shareholders on their applications. Whereas the next one is our pro rata allotment. In this situation, company should accept the shares, company should accept the applications proportionately. That means company should accept the shares in a particular ratio. So when company makes full allotment, then there is no need of any working note. No need of working note. But in case of no allotment, company should directly reject and refund the money. So we should credit bank account should be credited to refund the money on rejected shares. Whereas in case of pro rata allotment, where the acceptance is made on a proportionate basis, the company should adjust the excess money on allotment or future calls. So let's repeat again. The allotment means the acceptance of applications sent by the prospective shareholders. Generally, it is made in three ways. That is, allotment may be made as full allotment, or it may be no allotment, or it may be pro rata allotment. So in case of full allotment, 100% applications are accepted by the company. That means number of applications received is equal with number of shares allotted. Whereas in case of no allotment, all the applications are rejected by the company. So the applications money received by the company should be refunded to the prospective shareholders by crediting our bank account. Whereas pro rata allotment means acceptance of applications proportionately, where company should adjust the excess money received on application on allotment or on future calls. So now come to the our next point, that is mode of issuing shares. Generally, shares of a company can be issued in three ways. That is, the shares may be issued at par, or may be issued at a premium, or shares may be issued at discount. So the shares are issued at par means the issue price is equal with the face value or nominal value of the share. When the shares are issued at premium means The shares are issued at premium means issue price is greater than the face value or nominal value of the shares. Similarly, the shares are issued at a discount means issue price is less than the face value or nominal value of the shares. So issued at par means when the shares are issued at a price which is equal with the face value or nominal value of the share is called issued at par. When the shares are issued at a price which is higher than the face value or nominal value of the share is called shares issued at premium. When the shares are issued at a discount means the issue of shares at a price which is less than the face value or nominal value of the shares. In case of shares issued at a premium, security premium account is credited in our due entry. Generally it is treated at the time of the allotment entry, and at the time of shares are issued at a discount on issue account is debited in our due entry. Generally it is treated at the time of allotment when nothing is given, but when the premium or a discount is asked to treat at the time of any other calls, then it should be treated at the time of first call or at the time of the second call at the time of the due entry. So this is the mode of issuing shares of a company. Now come to our next important point, procedure of issue. Generally, a company adopts 4 steps for issuing its share. So such steps are issue prospectus, then second step is receive applications, and third step is make allotment, and fourth and last step is make calls. So in the first step, the company issue prospectus, that means the document that invites public to subscribe for the shares of the company. Here company invites the public or gives invitation to the public regarding the issue of shares and encourages public to subscribe for the shares of the company. In the next step, that is receive applications, here the company or the public apply for the shares of the company with the prescribed form. with the prescribed form along with the application money, that is 25% of the issue price, or as per the provision which may be at least 5% of nominal value. Then our next step is make allotment, that means acceptance of applications when minimum subscription is achieved, that is 90% of issue amount. Then the last step is make calls, that means the rest of the amount called by the company when it is due. But such calls generally made as per the provisions, that is call money should not exceed 25% of the issue price, and second legal provision is time lag between two calls must be 1 month. Then the next legal provision is at least 14 days notice must be given to pay call money. So these are the procedures must be followed by a company during issuing shares in order to raise the share capital. So now come to our next point is premium and discount. That means the shares may be issued at premium or it may be issued at discount. Generally, when the shares are issued at premium, our security premium account is credited in our due entry, whereas when the shares are issued at a discount, then discount on issue account is debited in our due entry. So the security premium is governed by the provision of section 52 of our Companies Act 2013. At the same time, the discount on issue is governed by or is governed as per the provision of section 54 of Companies Act 2013. Now come to the utilization of security premium. Generally it is used for issuing fully paid bonus shares, and it is used for writing of preliminary expenses. It is also used for writing of expenses on issue of shares or debentures. Security premium also utilized for writing of discount on issue of share and debentures. It is also utilized for buyback of own shares. So these are the utilization of our security premium. Whereas in case of issuing shares at discount, certain conditions must be followed or fulfilled for issuing shares at discount. So such conditions are: issue of shares at discount must be sanctioned by company law board, then second condition is rate of discount should not exceed 10%. Then our next condition is shares issued at discount must be a class which is already issued. Then our next condition is 1 year of business must be completed. Then our next condition is shares must be issued at discount within 2 months of approval. So these are the conditions of issuing shares at discount, and these are the utilization of our security premium. Then our next important point is arrear and advance. So in case of arrear, one additional account is debited, that is calls in arrear account, whereas in case of advance or calls in advance account is credited. Calls in arrear means the non-payment of call money by the shareholders in its due time, whereas in case of calls in advance means the payment of future call money in advance. So in case of calls in arrear, if our table F is adopted, then 10% interest per annum is charged, whereas in case of calls in advance, 12% interest per annum is allowed if the table F is adopted by the company. Then come to our next point, that is forfeiture and reissue of share. So forfeiture means cancellation of rights of shareholders due to non-payment of call money, whereas reissue means further issue of forfeited shares to a new shareholder at a new price. So our journal entry of forfeiture is share capital account to debit, security premium account to debit, to calls in arrear account, to discount on issue account. Then finally the balancing figure is share forfeiture account. In case of share capital account should be debited at called up value, and in case of share forfeiture, security premium account should be debited if not received. Then come to the journal entries of our reissue, that is bank account to debit, discount on issue account to debit, share forfeiture account to debit, to share capital account, to security premium account, and finally the balancing figure is our capital reserve account. So in case of reissue, discount should be taken or discount should be debited if it is originally discounted. That means the shares must be issued at a discount at the time of their first issue. So if the shares are issued at a discount and again the shares are reissued also at a discount, then the lowest amount should be debited in our discount on issue account, and the balancing figure is known as our capital reserve. So the profit on reissue generally transfer to our capital reserve account, and in case of forfeiture, the balancing figure is transferred to the share forfeiture account, and there is a condition for security premium in case of forfeiture of share, and there is a condition for discount on issue account in case of reissue of share. Now come to our next important point, that is specimen of cash book and the specimen of our balance sheet. So let's last but not the least important point of share capital is specimen of cash book. So in share capital or cash book records all the bank accounts where it is debited in its debit side, that is to share application account, to share allotment account, to share first call account, to share final call account. At the same time, it records in its credit side where our bank account is credited, that is generally arises in case of refund of share, that is by share application account. And when there is a reissue of share, so our bank account also debited again, that is records to share capital account. And finally the bank account should be closed, and the closing balance, that is by balance CD, is known as the cash at bank. The closing balance of our cash book is a transfer to the balance sheet asset side. So the specimen of our balance sheet, that is left hand side, is known as liability side, and right hand side is known as asset side. So the closing balance transfer to the asset side, that is cash at bank, and here we also records if any other assets are purchased by the company by issuing shares, that means issue of shares for consideration other than cash, or sometimes maybe shares issued to the promoters of the company. At that time another assets, that is goodwill, should be recorded in our asset side, and we record share capital in its liability side, that is differentiating credit total and debit total. Then we should record other liabilities, that is capital, reserve, security, premium in the liability side, and discount on issue should be recorded in our asset sides. Then we should compare all the journal entries where a particular account is debited and the particular account is also credited by differentiating the debit balance and credit balance. If we get any account or any accounts having excess of credit balance, then it should be recorded in our liability side, whereas the special account which have excess of debit balance over the credit balance, then it should be recorded in our asset side. Finally, our balance sheet should be closed. So these are the most important points of our share capital. I think almost of your doubts should be cleared if you watch this video till the end and share it with all your friends to give them opportunity to enhance their knowledge regarding share capital. Thank you.